Hi everybody, Leon Williams here with Luca Financial Services and the New Start family of companies, and I want to welcome you to this edition of the Financial Moment. Since our last episode where I talked a little bit about the Fannie Mae and Freddie Mac bailout, we've had a whirlwind of events take place market-wise on Capitol Hill, and I want to take a little time to talk about the current financial crisis and the $700 billion bailout bill that is still trying to make its way past Capitol Hill and was last shot down. There are a lot of people who are angry about what's going on, and there's a lot of political posturing on Capitol Hill with lots of blame that's going back and forth. So let me try to break this situation down and try to add some clarity to this complex problem. Essentially, the credit markets are frozen, and let's understand how this works and the reasoning for what's going on and this rescue plan that the government has put forth. And the biggest reason that it didn't get passed the first time is because of a lot of political posturing. A lot of people are talking about the blame for this, and I hear over and over and over about toxic mortgages as the cause for what's going on, but this really isn't about toxic mortgages. A lot of this has to do with the way accounting rules have come about. There's an accounting rule called mark-to-market, or the technical name is FASB, or FASB Statement 157. This mark-to-market rule is very interesting because it puts a tremendous amount of duress on financial institutions with the way they report. Every day, a lender has to mark their assets to market, meaning every day they have to evaluate what they are in the open marketplace based on where prices are, which is kind of like doing an appraisal on your home. Let's say every day you had to figure out what your net worth was going to be, and in order to do that, you had to do an appraisal on your home, and this particular day, your home was worth about $400,000. Tomorrow, your neighbor decides that he needs to sell his home really fast because he is in a bind. He needs to leave town quickly for whatever reason. Well, he decides to sell his home for $315,000 or $305,000 just to get a quick sale. Well, since he had to sell his home in a distressed sale for $315,000, does that mean your home is worth $315,000? According to FASB 157, it is. It does not matter that you could have sold your home without being in a distressed sale situation and got $400,000 for it. FASB 157 says the mark-to-market value of your home is now $315,000. The one determining factor that is not looked at is that you don't have to sell your home under duress or in a distressed sale situation. You could actually wait for a normal price. But FASB 157, or mark-to-market, says your home is worth whatever like homes are selling for, no matter what the reason. Now, how does this have such a devastating effect on the financial institutions? Because financial institutions are looked at in such a way that the market says, okay, we'll look at your asset base. We'll see what your assets are worth in this mark-to-market situation. Let's say your assets are worth $1 million. So we are saying the bank or financial institution is worth $1 million. And if you have loans outstanding of $15 million, then your ratio of loans to assets is 15 to 1. That's acceptable. Okay, no problem. But let's just say that some of the assets that you're holding due to FASB 157, due to mark to market, you suddenly have to take a $500,000 loss. And it's just a paper loss. Nothing has changed from one day to another, except one of the neighboring banks with assets similar to yours had to put them on fire sale, so yours are now marked down. Let's say your net worth has now dropped to $500,000. Your loans are still there, they have not disappeared, but now your leverage ratio, or your ratio of loans to assets, is now 30 to 1. And now red flags are starting to appear. The stock market looks at you and says, very, very risky institution, your ratio is now 30 to 1. What has changed? Nothing. But now the market views you terribly. You can't borrow money anymore. You're too leveraged, which means you can't make money anymore, and this continues the vicious cycle on and on and on. Now you have to figure out a way to get out of it. How do you figure out a way to get out of it? The only way to get out of it is to sell some of these loans on the books to get rid of them. But what if there's no marketplace for them? What do? You sell them real cheap just to get them off of your books. What does that mean? You take more losses, which means you can loan less money. It's a vicious cycle that just keeps repeating itself. And remember, as you're doing this, you are effectively putting comps out on the market for selling these things so cheap, which affects all of the neighboring institutions also. Now, throw into this some opportunistic shorts, which we are doing some illegal naked shorts here, meaning they didn't go out and borrow the stock shares to short them legitimately, and you have the market that is now in free fall, and that's exactly what we've been seeing. And when you look at the financial stocks and what has happened to them, Lehman and Merrill going under, actually, Merrill Lynch did some really smart things. They opportunistically and wisely bought some mortgage paper at 60 cents on the dollar. Very smart. They would have made a fortune, but because there was no marketplace for them, they were forced to sell. They had their backs up against the wall. They had to sell them for 22 cents on the dollar. And because there was no credit or liquidity, they had to self-finance 75% of it. In other words, they got a really great deal at 60 cents on the dollar, and they would have made a fortune, but they only got cash back of 5.5 cents on the dollar. These are the type of situations out there that caused Lehman Brothers to go under, Merrill Lynch to go under, put AIG up against the ropes and had the government step in. This is what we're facing right now. It's not a bad credit market because of quality or repayments. These are accounting regulations that were originally designed for transparency, which have gone crazy and completely out of whack. Most people do not understand these credit default swaps and these mortgage pools. The whole thing is not bad. 95% of the loans are paying with no problem whatsoever, but what we see here is that people don't understand what is going on here. They say, okay, I want to invest in A-paper loans. You can't isolate A-paper loans. Everything is thrown into an enormous pool, and they do that because of economies of scale and cost. You have A-paper, B paper, you have toilet paper, you have everything in these things, and if you want to be an A investor, what happens is you own the whole pool, and the way you're deemed an A investor is that you are sheltered from the first batch of defaults. So if 20% of the loans default, it doesn't affect you. Maybe when it gets to 25%, but that means you're very, very safe. It would have to get really bad for you to be at risk as long as you held it to maturity. That's the key word. The problem is if you can't hold it to maturity because of a fire sale, because your loan to asset ratios are out of whack, 30 to 1, 40 to 1, 50 to 1, if you can't wait till maturity to sell these things because of this fire sale, and you are really going to take a bath. Now, that in turn makes your capital less, which means you have to sell more stuff. It's a vicious cycle, and you put more bad comps out on the marketplace. The government's having a bad time with this. So what they want to do is add some liquidity. Now, the government is the only one that can step in and create a marketplace. They'll buy those assets, they'll buy them below market value, which means over time, since they have the ability to hold them and nobody is forcing them to sell, they don't have to worry about a fire sale. They don't have to worry about FASB 157 or mark to market. They can hold them to maturity and know that 95% of these things are going to pay off. And you know what? The government will make a bundle. It will be a home run, just like this, the deal that they structured with AIG. They're going to make a ton of money on that. But Congress doesn't understand, and the general public is having a hard time because this is tough stuff to understand. This bill is going to pass in some form or another, and it will start to free up the housing market, and that will make everything better. So I hope this has helped to bring about some clarity to this really complex situation. Just understand, we will get through this, and this is truly a historical event. You'll be able to say that you lived through this historical event, and the knowledge and wisdom that we will gain, we will hopefully be able to pass to the next generation. If you would like to call and talk with us about our 8 steps to wealth transformation process, please call the number on the screen. If you would like to learn more about our option arm analysis service, our asset optimization services, our mortgage under management system, or come in for a complete financial checkup to make sure that you're not only weathering the storm, but that you are prospering, please give us a call. Again, thank you for this edition of the Financial Moment, and we'll see you next time.